Welcome again, everyone, to the Arcan Capital Fireside Chat podcast. With me, as always, Andy Lorber, and I am Steve O'Brien, both of us from Arcan Capital. We have taken a little bit of a break here since our last chat. The reason is we got a lot of positive feedback to this, and we're going to continue doing it, probably in a little bit more formal of matter. We've brought in some experts to help us with production value and to reformat so we can continue delivering these messages and these chats and information. And in fact, we're going to do it in a way that I think will be pretty exciting for you, where we can share a little bit more in detail about our investments and what we're seeing and get in a little bit more than we have been for a podcast that we're posting to YouTube. So please stay tuned to that. The reason we're here today is because we just had one of the largest apartment conferences in the world. Probably the. And we thought it was a great time to come back and talk to you about that. So that apartment conference is called NMHC, and I'm going to let Andy talk a little bit about what that is and why it's important.
So NMHC, as I said, it's the largest apartment conference in the world, to our knowledge. It's certainly massive. Attendance, we've been going for 10 plus years now. Attendance is typically somewhere between 20 and 50,000 people, depending on the year. It's interesting because you'll notice more people attend in the good years and fewer people attend when there's not as much going on. So going in 19 and 20, there was a lot. And 23, I would say very few. But we're starting to get back to some activity, which I think is really one of the key takeaways. So, broadly, again, biggest conference, thousands, tens of thousands of people, and it's everybody. It's lenders, it's sponsors like us, it's equity partners, it's vendors. It's really the entire universe of multifamily professionals. And because everybody is together in such tight quarters in Las Vegas, there are a lot of meetings. There's a lot of data that's exchanged, and we learn a lot every year, even though we're only there for 3-4 days. So, typically what this looks like for us is, think about speed dating, right, Steve?
Yeah.
You're having 15 to 30-minute meetings. We averaged about 20 meetings a day, which is pretty high volume, but not atypical. And we met with everybody. Again, we met with existing partners. We met with future partners. We met with people that we just really respect in the business and traded, ideas and concepts. And
we met with competitors.
We absolutely met with competitors. That's part of why we go, frankly.
To get the intel.
Yeah, that's right. We want to and they're friendly meetings with competitors, right? Because, we all have operations that, have challenges and opportunities, and to be able to share some of that is really helpful. And your competitors in that scenario are oftentimes willing to help you. Maybe not when it comes to buying a deal, but certainly when it comes to operations, I think people generally are trying to make everything better. So,
well, in our space, competitors are a little bit different too, right? Nobody can buy all the apartments.
That's right.
And everyone's trying to make money. And just because you make money doesn't mean I can't. And in fact, one of the things we actually really like about real estate is if your neighbor, who also has an apartment complex, is doing really well, they are helping increase the value of your investment too.
Mm-hmm.
If they're improving the neighborhood, your neighborhood is also getting better. So it's a little bit more collaborative than, say, like, Nike and Adidas, right? They view each other as, if you're buying that shoe, you're not buying ours.
And nobody's worried about market share, right, Steve?
Yeah, there's plenty of apartments, especially in the Southeast, where we're competing. Maybe you feel a little bit differently in some of the other markets, but when you're moving a bunch of people in, and I'm sure everybody, if you didn't, you should go take a look at the recent census numbers. The census keeps telling us the same things, which is people are moving to the southeastern United States, the South. They like it here. It's probably the weather, even though it's been a cold winter. But it's a number of different things, and it's growing. And as long as it's growing, you have the opportunity to build new apartments and to occupy them.
That's right. So, getting back to MHC, I think I would really like to discuss with you kind of what some of our key takeaways were, because this is the first year where you and I had different experiences, right? During the conference itself, we met with different groups, we met with different people. We came away with the same ideas and the same takeaways, but we heard them, I think, from slightly different participants.
Well, let's give a lay of the land. So when you're talking the information we're getting, I think we're really talking about 3 different parties, right? You're talking about lenders, you're talking about owners and operators, and you're talking about sellers.
Can I add a fourth one to that?
Yeah, sure.
I think the brokers.
Yeah, and the brokers. The brokers are obviously, because the brokers, not dissimilar to what we're doing, they're talking to everybody and trying to serve everyone as well. What's become most interesting this time is that all three of those parties, owners, sellers, brokers, and lenders, are all kind of doing the same thing right now, right? We all have assets, or in the lender's case, are going to end up with some assets that maybe they don't want, meaning not that they don't like the real estate, but if you're a lender and you end up owning a property, something bad has happened. The lenders want to, and I think this is important to remember, why lenders can be difficult and salty is because if they make a loan on a property, all they get is the interest. It doesn't matter how well it does, it doesn't matter how badly it does. They want the interest, and then they get their principal back and they move on. People like me and Andy and investors, when you make an investment, your upside is not capped, but lenders are capped. So they're always worried about their downside, and they're experiencing a lot of that downside right now. They are taking back properties, or what's most interesting, I'm leading you down a road here, they are contemplating whether to take properties back or not. And I think that's maybe where a good starting off point is for us.
I think it is too, Steve, because I think that's really kind of where we are. Obviously a lot of the conversation in MHC revolves around what's happening in the market and what people think are going to happen in 2026. And where we are right now is, to your point, there are a lot of deals out there that are challenged, or, I'm going to hesitate to use the word distressed, but some of them are distressed. They're not current on their loans, or they've had a maturity that they've kicked out 1 or 2 years by extension. And the lenders, don't necessarily know what to do with a lot of these assets. So that's part of why the market transaction volume hasn't been as great as it has been in previous years, because everybody's dealing with these, legacy issues. Well, the lenders are the first group that needs to act here, right? Because at the end of the day, to your point, their upside is capped. They're all about mitigating their downside risk. They don't want to take these properties back. Let's be honest about that.
And when Andy says take them back, that means foreclose.
It means foreclose.
It means a deed in lieu of foreclosure, which means the owner, the people like Arcan, Andy and I have loans on every property that we own. That would essentially be the lender coming to us and saying, this isn't working, you can't pay your debt, we are going to take this property by force back from you. And when they do that, they eliminate the position of every investor. Mm-hmm. So if you invested $10 million into this particular property and the lender takes it back, your money goes to zero unless the lender sells it and recoups all of their costs, all of their interest, and their loan. Then in theory, whatever's left over goes back to you. We don't see that happen very often.
No, it doesn't happen very often.
Normally, you just get wiped out when that happens.
So in order for the market to start moving again, lenders have to become more active in taking back their bad deals. And that's what we're starting to see. Again, it's not their business model. A lot of them are still trying to figure out how they want to do this. And it's really an asset management function. And we can talk about what that means very specifically. But it essentially means strategically what they should do with it once they actually have it back under their control. And so each lender has its own strategy. Each lender has got a different take on the market. It also depends on, frankly, their partners, i.e. their Arcans, and what the position of the asset is in the market. If it's worth what the value is on the loan, they're probably going to take it back and sell it pretty quickly. Yeah. And this is most right now, if it's worth less than the value of the loan, and that is I would say, majority of the market, then that poses a real question as to what they're going to do. And we came out of NMHC, again, going in with, I think, some of what we knew already, but nevertheless, it's always interesting to hear it. A lot of lenders right now are still very much trying to figure out how they're going to approach taking back the properties. The difference is, in my view, and I want to hear yours on this too, Steve, the difference is lenders are now serious about actually taking back these properties or forcing their borrowers to do something.
Yeah, it depends on what your definition of serious is.
Yeah, fair.
But no matter what, I think the one thing we agree on, no matter what, is that lenders taking a property back is kind of like amputating an infected appendage, okay? They don't want to do it. Yeah. They're going to exhaust almost everything they can think about. They're going to get as many doctors to look at it and say, are you sure I need to cut my arm off? And sometimes it's just a pinky. Sometimes it's a whole arm, right? And that is determined by the value of the property. Sometimes it's, well, I'm going to take this back. The loan is $40 million and I can probably get 39. That is not nearly as painful as I'm going to take this back. The loan is $40 million and I can only get 30, because that means they are losing the $10 million. Not only have the investors lost money, but so is the lender. And none of the deals we're talking about right now are worth more than the loan balance. Agreed?
Agreed.
We are talking about.
Agreed.
So here's where Andy and I will disagree on serious. I agree that they are also serious, but their math is not serious, meaning they are taking these assets and saying, I'm going to take this asset back and I'm going to sell it for my loan amount. When Andy and I are looking at the deal and saying, you made a loan for $40 million, this property is not performing and it's worth 36. And you're trying to tell me it's worth 40, and we are underwriting it and living this every day as owner operators and putting it through our models and saying it is not worth $40 million. So what are you going to do? And unfortunately, what I think we're still experiencing, which is holding up the market in general, is lenders saying, well, then we'll hire a property manager and we'll just run it until it gets better. And that's kind of been the game plan for about 2 years now.
Yeah, between that and extending the loans,
Right.
I think when I say getting serious, to your point, I actually think you and I agree more on this than maybe you think we do.
Yeah.
Getting serious to me means they're taking the property back. That's step one. They haven't moved beyond step one.
Right.
Right?
Well, they've tried to operate them.
Some of them are moving to step. That's step two.
They've tried, but their method for trying to operate them was, okay, the current borrower hasn't panned out. Let's pretend it's not their fault, because candidly, I mean, this is a good thing to back up and say, let's talk about the problems. There are two types of problems, and Andy may think of a third while I'm talking here. The first type of problem is bad timing. I put a loan on it. It was a reasonable loan, but I bought it at the peak in 2022, and it was a bridge loan for 80%, and my interest rate climbed up to 9. Now it's 7.5 because there's been a little bit of relief in the market.
And so I think we've discussed this in prior podcasts, but this pricing is done over SOFR, the secured overnight financing rate.
Right. So
floating.
It is. We are not at our highest level of interest rates. We're still high by comparison to the last decade, but we're not at the highest we've been. And there's some downward pressure on rates that we've seen in the 10-year and SOFR and 5-year treasuries, et cetera. So it's not as bad as it was, but they still can't afford to pay the debt. And the lender said, why don't we reduce the debt? We're going to give you a year to try and figure this out, because everyone, including us, frankly, is hoping and was hoping that this was just a blip on the radar, and that this end of cycle reset wasn't as much of a reset, but was transitory. That's a word we like these days, coming from the Fed. And the reality is, I think everyone is coming to the conclusion that this is not transitory, as Andy and I think have been telling you since the beginning. Mm-hmm. This is the new market. Is it going to get better? Yes. Are we going to get rate increases eventually in market rent increases? Sure. Yes. Are interest rates probably going to continue to come down a little bit? Probably, maybe.
Do you mean to say it's a cycle?
Yeah. So we're going back through the beginning of the cycle, and I think a lot of people have to get adjusted to that, and they all know the truth, and you guys should know the truth too. You're going to look up in a few years, and people are going to be making money on apartments again. And they're going to be distributing, and cap rates are probably going to be a little lower, but you have to get there. And by not transacting, by giving loan extensions, by kicking the can down the street, you are delaying that process, because you have to take your lumps. Mm-hmm. You have to get the good operators in that are going to invest new capital in the deals, that are going to convince new tenants to come and pay you a little bit more. Just sitting on your hands and waiting for it to get better slows down the process by which it gets better. There is very little data to tell you that. It's just, I guess, what I believe. I mean, do you agree with that?
No, I think that's my observation very much as well, right? Okay. Which is, in order for the market to get better, people have to take their losses.
Right.
It is what it is. That's always the case. And the more you extend and pretend, maybe you can mitigate your losses at the margin, maybe, but you're still going to take some losses. So, I think in our view, it's isn't it better to take them now, recycle that capital, get the market moving again, and rising tide lifts all boats. But that's not realistically what's going to happen.
And
it's not what's happening.
We remember doing this the last time when in 2010, 11, 12, when I first started buying apartments, I would talk to people, and I famously, one of my favorite stories is I sat down with a gentleman who had some bad investments from the GFC 2008. And I gave him the pitch for why this was 2012 would be the apartment buying opportunity of our lifetime. And he said real estate was a 4-letter word in his household. And you understand why. Everybody got hit really hard, as some people have gotten hit. It's not as bad. This is not nearly as big of an issue as 2008. I mean, that was a systematic near collapse of our system. This is just the end of a cycle. People made some bad investments,
Yeah.
and we're going in a bad
People
direction
always buy at
for
the top
right
of the
now.
cycle.
Right.
That's always the case.
But we are convicted that now is the time to take your lumps and get back active and buy things, because for the first time in a long time, our models are spitting out numbers that are very attractive to us, basis, return, et cetera.
Yeah.
And we all know that rent growth is going to come back at some point. So the question is, how much pain are you willing to go through as an owner in order to get to the success? We would argue that anybody who bought something in 2012 wasn't really excited about their first year or two. But by 15, 16, all of a sudden you got really excited about the rent growth you were seeing and the valuations on apartments. We would relate that to today, but it's really difficult to get off the sidelines when you've got some pain in your portfolio, except the fact that compared to '08, as a reminder, the pain in your portfolio is a deal here and a deal there. When if everyone went back and looked at their portfolio going back to 2012, I think you would have taken all of the lumps at the end mixed with all the success you had along the way, because it was a really good cycle.
There's no question. So let's continue this theme, right?
Yeah.
We've really hit on the lenders. I think we're pretty good at where we are with that. Do you want to talk about other sponsors, other equity partners?
Yeah, I think sponsors and equity partners is a little bit easier to talk about. Everybody's nervous.
Everybody's nervous.
Everybody's afraid. Should I get off the sidelines now, or should I get off the sidelines in a year? What am I going to miss? And I want to hear your opinion, but I think what we would say you're going to miss is an opportunity when 75% of our competitors are out of the market. So at its peak, when a great property came to market, I mean, we were hearing about 100 offers on a single property. We are chasing some assets right now where I think there are 5 offers on the table. So that is a massive change. What that means to us is there's a lot of capital out of the system and
sitting on the sidelines,
and we are able to almost certainly get a better deal right now with all the metrics being the same than we will in a year, because there will simply be more people chasing the investments. So our opinion is now is the time to selectively buy, because we are also seeing deals that are too expensive where if you just pay market.
Right. Well, we can talk about the sellers in a second here too, because some sellers still have very unrealistic viewpoints. But to your point, Steve, I think one of the things that I walked away from NMHC was, a lot of these sponsors are dealing with legacy issues still, much like the lenders, right? And they are sitting here saying, I would love to go out and buy new deals. There was nobody that I talked to who didn't agree that this was a great time to buy.
Right.
It's the ability to execute that is the differentiator right now. Because groups like us who don't have a legacy issues in our portfolio, and that's not to say everything's distributing in a 10, right? But we've no floating rate debt. We have no real problems.
We're not expecting any capital calls.
We're not expecting any capital calls. We haven't had any capital calls. So many of our competitors are, even the ones that we really respect and we think are great operators and great investors, they're all kind of still looking over their shoulders or focusing on the 1 or 2 problems in their portfolio, even if they've got 20 deals that are performing well. And because of that, they are also sitting on the sidelines to a large degree. And that was a lot of the sentiment that we got coming out of NMHC was, man, I wish that we were being more active and looking at deals right now. Now that provides us with a lot of opportunity, to your point, because there are only 5 people chasing a given deal at this point, whereas 3-4 years ago, there were 40, 50 people even chasing those same deals. So there's a lot of opportunity that's inherent there. And that's kind of what I walked away with in my impression of where our competitive set is.
And to throw in the equity partners on that, which are also owners, right? Think about how and we've dealt with this a little bit too. When you're calling an equity partner and saying, hey, go invest in this deal, and they say, now is the right time to invest. But man, when I put this in front of my partners, the first question the guy with the checkbook is going to ask is, what about that deal XYZ that just had a capital call? What's going on there? Don't we need to handle our problems before we start reinvesting in new stuff? Andy, and my opinion is, no, you don't. You should handle your problems, but there's a chance that if you're focusing only on handling your problems, you're going to miss a good investment opportunity. So, and trust us, apartments aren't the only thing we invest in. Andy and I are happy to write off bad investments and keep investing in other things. We have done that plenty, so we do practice what we preach in that regard.
It is tax time. I am writing one off right now.
Yeah, we are. So I do think that is an interesting nuance of what's going on right now. Almost everyone to a T, to your point, that you talked to said, good time to buy, we should be out buying. And then when you say, why aren't you? well, I got this deal to figure out. My capital's a little bit nervous. It's a challenge right now. I'm not sure what things are worth. And that is what's going on in the market. When you don't have a million transactions to look at to tell you what a property's worth, you're guessing as to what the value is today. And you could make the argument that anything you bought a year ago went down in value. Now that assumes no rent growth. That assumes operations aren't any better. So there are a lot of assumptions there.
You've done no improvements to the property, right?
Yeah. But we would almost say it's not a bad. We wouldn't almost say. We would say that it's a pretty good investment thesis to say I'm going to buy a bunch of stuff today. I know it's not going to go up for a year because I can get almost my pick of the litter right now on the properties that I want to acquire.
That's absolutely right. And let's be honest, Steve, real estate is not a short-term investment. It has been turned into that in the last cycle. But the truth is most people historically hold for at least 5 years. Right?
You should.
And you should.
It's not a short-term investment.
It is not a short-term investment. And if you view it as such, then I think that you're going to get washed out of the market, which a lot of people have. So if we're looking at this at a 5-year time horizon, which we are, I look at our basis right now and say, I don't care that it's worth a little bit less in a year. It may also be worth a little bit more in a year. Let's be honest about that too. Right? But it doesn't really matter to me what the value is in the year. Are operations good? Am I starting to cash flow if that was part of my original thesis, right? How is the property performing? And then I'll look up in 3, 4, 5 years, and I think that's when we're going to see a lot of value start to pop.
Well, some of the properties we've acquired in the last 2 years, the interest rates are down meaningfully from where we acquired them.
That's true.
And we've actually taken a look at doing some supplemental loans or even refinancing stuff that we bought a year or 2 years ago because interest rates are down enough if it made sense. But I think that, again, that's a little bit more of a simple one. The equity partners, operators, buyers are all thinking the same thing, which is it's probably a good time, but how am I going to buy it and how do I get it over the finish line? I think that transitions perfectly into sellers and brokers.
Yeah.
Which, sellers are very simple. Sellers are just buyers with a deal to sell, right? And the joke that we always make is when you're a seller, it's worth twice as much as when you're trying to buy it, the same asset. And I think the seller problem now is they'd be selling everything if they were making money, but it's really hard to sell stuff when you're going to lose money.
That's exactly right. No, it is, Steve. That's the thing.
Whether it's a nickel or $10 million.
Yeah, nobody wants to lose money.
Nobody wants to.
And I understand that. I don't want to lose money either.
Well, we're doing it right now. We're not selling anything right now.
That's correct.
Right? And because we think in general, we've tried to create a position within our portfolio that allows us to not be forced to sell when we aren't prepared to sell. And it's very simple, but we like to buy low and sell high. You can make a lot of arguments about where we are in the cycle. I don't think you can make an argument that we're not at or near the bottom.
Frankly, I've not heard anybody making the argument that we are. Right? Everybody, I think, agrees that we are at or near.
We are at or near the bottom. And part of what you can feel that, skipping again now from sellers to brokers, is brokers just want transactions.
Yeah.
Okay. And I think they are a great ally for us and for the market because they want transactions. Their goal is to get people to see what the real number is, to explain to buyers that it's a good opportunity to buy, and to explain to sellers that waiting is probably not going to solve your problems. And I think they are working really hard to do that.
Let's be honest, there's nobody working harder in this business right now than brokers.
For less. Yeah. The brokers are out there cranking, doing just as much work as they were previously. But instead of selling every deal like hotcakes, they are having to fight and scratch. And just so everyone understands the pricing too, people are happy to sell when they're making money and transactions happen quickly. Now, when they're losing money, the sellers are more obstinate about pricing, about who's going to buy it, about a number of different things. And half the time, you have brokers doing an enormous amount of work and it's just a pricing exercise. The sellers look at the number and they say, well, I'm not selling for that. So you've wasted all your time. And I think that is probably going to start to change a little bit here because from a broker's perspective, 23 was probably the bottom.
Yep.
Right? Transactions in 24 were a little bit more than 23. Transactions in 25, a little bit more than 24. And we're expecting the same thing in 26. I think 26 is off to a little bit of a slow start. Andy, to give him credit, always said that this wasn't going to be a bubble bursting with a bunch of properties to acquire. It was going to be a dam overflowing. And I think that's what we're seeing. You're seeing a decent deal here and there. And that doesn't work as well for the brokers. The brokers want it to be littered with great opportunities to buy and sell. And that's really not what we've seen or what we think we're going to see.
No, I think we're going to continue to see the dam. I think that metaphor continues to be apt. I don't foresee that changing this year. It will change at some point, Steve. Not because there's going to be a bubble that bursts, just because money's going to come off the sidelines and there are going to be more transactions and values will increase, and that will induce more people to sell.
So,
Right?
so what's it going to take? We're running near the end of our time here. I think we've hit, what we wanted to hit in this,
Yeah.
and I want to give you a chance to take a little bit of a what's 26 going to look like? Good year, bad year. Um,
Yeah,
what do you
so
think?
I mean, I think, and again, I'm going to draw on what we saw at MHC because I think that gives a good sense of market sentiment. Somebody wise made the observation that if the market is going through the stages of grief, right, we're in the acceptance phase. People understand what their values are. They may not want to transact at these values, but everybody knows where the market is. Everybody has a good sense of where values are today. And so, that is key to moving to the next step. I think 26 is going to be 2025 plus 10%.
Okay.
Okay. I think it's going to be a little bit better. I think values are going to continue to stabilize where they are. I don't see values going anywhere this year. They could go down maybe, but I think we're kind of near the bottom, especially as interest rates have continued to float down a little bit. I think that's giving some support, right? And we've had some interest rate stability, which has been really helpful. So I think price discovery is pretty much there. I think that we will ultimately see some more transactions, some of which will be from the lenders, some of which will be from equity partners who just have to throw in the towel because they can't keep kicking the can down the road for either they can't bring new capital to the table, the lender gets, is saying I'm done, or they just sit here and say, you know what, I'm going to take my lumps and maybe I'll go find something else to buy, and my equity partners trust me to do that because there are a lot of groups like that too.
Yep.
So I think it's going to be a little bit better than 25, but from a transaction volume standpoint, and hopefully from an Arcan standpoint, we can get some more deals done this year. But I don't think that this is going to be a big recovery year at all. I think we're probably at a minimum 24 months away from that. I think that's 28 at the earliest.
I would totally agree with you, and since we do agree, I'll throw in just a couple of extras, which is I think at the end of this year, you will start to see some performance increases on select markets.
Yeah.
Where maybe there's some rent growth as we get through the massive pile of construction.
Which is very, very market dependent, right?
Very market dependent. So some markets are far away from recovery. Like, we think Charlotte has a little bit longer to go. They got a lot of units under construction. Atlanta has less than a year of inventory in new construction based on T12 absorption. So we feel pretty good about Atlanta. We feel pretty good about some other markets. And I do think that you're right about the year being of acceptance. And the question will be, what are you going to do with that acceptance? Are you going to take your lumps and move on? Or are you going to stick it out, find people to run these better than the last guy ran it for you? And I think this year will be a decision year. I don't think it's going to get a little bit better. I agree. 10% is probably a good number, 10 to 25% in increased transaction volume. I don't think you're going to see prices go up. I think prices have hit the bottom. And I think 27 is going to be the year of, okay, we've kind of figured this out. Now we're going to do some more. And if you're looking for a year that we'll move on and feel like a whole new cycle and people will start to get excited, I think you're going to have to wait till 28. I think you've got 2 more years of this sentiment, this feeling. It'll get more and more positive as you go along. But what we're waiting for is that first quarter when everybody looks around and goes, did everybody bump rents this quarter? Yeah, just about everybody did. Well, here we go. And I think that's what we're waiting for. And I don't think that's going to be 26.
No, I don't think it is either. I think it's going to be 28. Maybe 27. It'll be 27.
Yeah, 27, 28.
And then capital will start really coming back in 28, 29 is my guess. And then we'll, off to the races once again.
Yeah. Well, that's all from us today. Like I said, stay tuned for our reformatted episodes. If that takes a little bit longer, we'll do another one when it's necessary. We'd love to hear back from you guys. If there's something you want us to talk about, email us, call us, let us know. Thanks again, as always. And for Andy, Steve, signing off from Arcan Capital.
Thanks for tuning in.
Thank you.